Hi, this is Bob Iaccino talking S&P futures from the CME Group trading floor in Chicago. We are on data watch for this week. It's a very, very big week of data ahead of us. We got a little bit of that data today, but most of the big data is ahead. We're getting two separate indicators of price changes, consumer price changes, a second iteration of CPI for the Eurozone, as well as the PCE deflator we're going to get here in the US, which again is another revision. But we're getting looks at these prices along with some other pieces of data that could push the Fed into a little bit more hawkish language or continuing in that sort of slightly dovish to mildly hawkish language, which is essentially neutral, that they've been involved in. Janet Yellen has spoken very quietly, has omitted any hawkish language, while you have Loretta Mester, Esther George, Robert Kaplan, all speaking a little bit stronger in terms of shrinking the balance sheet. But this is a big week of data all the way out to non-farm payrolls on Friday. Well, by the way, if PCE is very strong, non-farm payrolls won't matter as much, but it's not expected to be. So if it comes in line, then the strong data at the end of the week, a strong jobs number, gives the Fed that continued cover to say that they can actually start to reduce the balance sheet. We did have inventories today. Wholesale and retail inventories come out, and they kind of canceled each other out. Retail inventories were down, which is a bad sign for GDP. Wholesale inventories were up, which is a good sign, and they kind of washed each other out in terms of their beat and miss versus analysts' expectations. We did see trade balance today, international trade balance, and the U.S. is put in a worse position than the prior month, which could get even worse with Harvey, because Harvey is affecting the Houston ports, which energy is exported from. So again, that's going to take away from coming numbers, but we have still yet to find out how much damage has actually been done. Now, we also have the dollar, which is weak and getting weaker, down close to that 93 level in the dollar index. And the weaker the dollar gets, it shows you the market has less and less faith in the Fed that they're going to start cutting back on that balance sheet and taking dollars out of circulation that they've been using to buy assets. Now, remember, if they do normalization of the balance sheet, they are not selling securities. They're just taking the money from the expiring or the maturing securities and not reinvesting them into similar issues, sending that money back to the Treasury. So that takes money out of the system. Now, if they go through with that, you should see a little bit of a basing and maybe even a bid to the dollar. But so far, we're not seeing that. It's weak and getting weaker. This is Bob Iaccino talking about an unchanged S&P from the CME Group trading floor in Chicago.